Welcome to Investors Insight, where today's topic is reserved optimism. So the year has already started off with some choppy markets as the uncertainty around the Fed and the cuts that we're expecting continues to cause volatility. So Trey, let's start with you. You made some great points of corporate earnings. Talk about that.
Yeah, absolutely. The fourth quarter earnings reporting season is kicking off this week, and it's a very important earnings season because it gives us the close to 2023, but then really starts with the projections for 2024. Currently, analysts expect the S&P 500 companies combined to produce $244 in earnings for 2024. That puts the market at about 19 times that earnings expectation. Not really overly, not too expensive, not too cheap either, but it represents an 11% growth rate in earnings. So that's very positive, 11% growth rate, but that comes with two drawbacks. Drawback one is the interest rate market is currently expecting 6 rate cuts from the Federal Reserve. It's very unlikely for the Federal Reserve to cut interest rates, bring cost of capital down if S&P 500 earnings are going up by 11%. That's more of an inflationary environment, that level of earnings growth. So those two things seem to be in conflict. And the second is I can show you on this chart. What this chart indicates is looking backwards, what earnings estimates were for 2023, for 2024, and 2025 going backwards. You can see that earnings estimates always start high and then come down as reality occurs. And so we're starting right now at 244, but if history is any guide, we would expect that number to fall as reality happens. And earnings season kicking off this week is going to be our first indicator of reality. And so we may see these numbers fall. And so it's really a conflict of starting off great, but it may come down. And then if this really does happen, then the Fed's likely not going to cut rates. And so the market's kind of in a point of conflict right now that will begin to resolve as companies report earnings this week.
Yeah, that's why we titled this vlog Reserve Optimism. There's optimism in earnings, but there's still uncertainty around what the Fed's going to do. And we've been looking at tailwinds for the market in recent days. And one area that we're excited about is that the U.S. job market is looking healthier than many had predicted. So before Ty gives an update on the actual job numbers, I want to focus on what sometimes is overlooked in the Labor Department's report, and that is wage growth, which, as you can see in this first chart here, continues to improve and go higher than inflation for the first time in 2 years. You can see that the average hourly earnings in the blue line was consistently above inflation, which is above, shown in the orange line, from 2016 through April of 2021. But much of the last 2.5 years, inflation has been higher than wage growth. So higher wage growth has been a big driver of the robust consumer spending, which has been a leading driver of solid corporate earnings that Trey talked about, and a stronger than expected economy. And this matters for markets and will be a key driver for the market in 2024 if we see wage growth continue to go higher and inflation continues to go lower. So Ty, I just hit on wage growth. Talk about the actual job gains.
Yeah, so headlines were good. Added 216,000 jobs in December. The unemployment rate stayed at 3.7%. The problem is that we've kind of been in this trend where the last few months, every time there's a report, there's also a revision downward to prior months, and we got that same again. So we added 216,000, but the months prior were revised down 71,000. So not as big of a gain, kind of as we were hoping. And as I mentioned, the unemployment rate held at 3.7%, which is fantastic. But the labor force participation, the amount of people in the workforce or actively looking for work, actually fell pretty sharply to 62.5%. Not something we want to see. We want to see that labor force participation grow. As we know, it's a tight, labor market out there. A couple more concerns: the work week declined, and then people with people holding multiple jobs increased, and those with less than a high school diploma, their joblessness actually spiked, which can be kind of a leading trend for others that follow in other kind of states in their lives. And so that's something that we want to watch, certainly.
Yeah. So again, there's optimism around everything we've discussed, but there's also uncertainties, and that's why we have reserve optimism. So thanks for watching. If you have any questions, as always, please reach out to us, call us, email us. We look forward to keeping you informed. Thanks so much.